already know what it is. The inflation numbers, they came out, the CPI numbers, and they came out and they were about 8.6. So at this point, from the talks that I'm hearing, a recession is imminent. You know what I mean? It's all falling. Like eventually it's all gonna fall. And I really wanted to figure out what I plan on shorting, because I want to make some money on the way going down. I don't just want to make money on the way going up. I want to figure out what stocks I'm going to short, how I'm going to go about it. And I came across an old video from Graham Steffens. It's called How to Make Easy Money Short in the Stock Market. So we're going to roll a clip. We'll see if we learn something. And if we don't, I'll come back and I'll do another video on the stocks that I am shorting, because I was thinking about it. I planned on buying stocks, but instead now I'm thinking I'm going to start shorting instead. So let's go. Oops. Stand by for a second. Technical difficulties. We'll get this up real quick and go from there. I don't know why it was working perfectly before, but once I click. But anyways, it should be good now. Let's see.
Easy intro.
There we go.
What's up here, Graham? Guys, it's up. And I have no idea why you like these crazy intros, but you know what? If you enjoy them, I will make them crazier.
I think they're corny. I don't know who's telling them to do it, but please stop.
So anyway, as usual, we got Robinhood and their investors back in the news today, but for different reasons than I've discussed in the past. That's because no, this is not another infinite monetization loop. I wish. It's not a hack either, and no, it's not another outage that leaves you unable to trade your precious Tesla call options. Instead, it has to do with Robinhood investors themselves and the stocks that they're picking, and why so many of them are losing money. Now I know you might be thinking to yourself,
Robinhood investors losing money is nothing new.
And by now it's almost as though the app has transformed itself into more like a Vegas casino, where instead of betting against the house, you're patiently waiting for those Palantir tendies to print. But this is different, because now the data has been released on just how much money Robinhood users are making and losing, and also how people are profiting from this information, because there is a pattern as to which stocks to buy in, how high they'll go up, and then when they will go down. So don't worry, I'm not going to leave you in suspense about this any longer, because there's some really juicy information we got to talk about. But before I begin, because this video took me a long time to research and create, it would help me out a lot if you invested in the like button or you destroy it. The best. Alright, so here's what started it all. Bloomberg recently published
I just want to hear about the stocks. See, this is the problem when it comes to like trying to learn. And the weird thing about it is, while I was doing this, I couldn't find any like Jeremy from Financial Education always talks about 10 stocks that I'm buying. But I was looking and I didn't see anyone talking about stocks that they were shorting. And honestly, I don't think he's planning on talking about that as well. So I'm going to roll a little bit more, and then I'm going to find a different video to react to, because I don't want to hear this. This video is 2 years old, and I thought he was going to talk about it, and it might have some relevant information, but we'll see. Darryl, what's going on with you, man?
Minimum, they condense the information down to really just the basics. And because of that, their users end up making their investing decisions based on a limited number of factors. One of which is called the top movers section, which features the stocks with the biggest percentage moves for the day. Well, this study argues that the simplicity of that design will subconsciously direct their users to invest in the stocks that grab their attention. And what's more likely to grab your attention than the top movers section? Or really, in other words, if Robinhood lists a stock in there, it's more likely to be bought. Now, in terms of how big of a deal this is, this study goes further to say that Robinhood users are more likely to be influenced by these choices because, one, half of all Robinhood users are first-time investors who are heavily influenced by chasing returns instead of developing their own method of picking stocks. Two, the Robinhood app directs users to the user ratios in just a period of time. And fifth, because nearly instantaneous.
I'm gonna skip through this because I'm looking for something which is easy money short in the stock market
without realizing what they've just done. And fifth, because Robinhood users are more likely to buy and sell a stock within a short period of time, they're more likely to trade speculatively instead of investing.
We don't care about Robinhood. Robinhood is trading terribly right now. Things at like $8. And I heard Jeremy talking about they have more cash on the books than basically if it hits $7, there's gonna be more cash on their books than what the stock is worth, which is crazy. So basically you can buy it for free.
That someone else in the future is willing to pay more money for the stock than they paid today. This is especially
Let me see if I can find something else. This ain't working out. Let's see. Because I was looking at thinking about shorting like the S&P 500 or something like that, but honestly, I've mostly done long-term investing. When I first got started, I started with penny stocks and stuff like that. I made money, I lost money. And then after that, I went from there to how to short the S&P 500 to just now I just only trade long term. So, oh, this might be interesting. S&P 500. Trying to get y'all the newest. Oh, this one is this guy. Let's see. All right, I found two things that we could take a look at. Let's see.
Markets Smith by Investors Business Daily is a powerful stock research platform designed to find winning stocks before they're
Skip that. Skip.
Was today non-farm payrolls. If you were short, whoo, that farm payroll change, right? They're expecting.
And y'all, this is really how my brain works. So y'all are really getting an in-depth feel for how my brain works. I hate when people pull up the charts.
Candle wicked this low right here, and then whoop, rally back up. Now,
Can I be honest with y'all? I think, and I have a homeboy that was trying to learn how to read these charts. I think it's the biggest BS ever. And I remember watching a video where the guy was saying if the chart is going up, it's most likely going to keep going up. And then if the chart's going down, it's most likely going to keep going down. Like, the richest people in the world, I just don't feel like they really spend time really studying these charts and inverse candles because they can always be wrong. Like, there was no one that would have predicted the Demic. I tell you that. So
Inverse.
let me see. This is the last, and I'm gonna get out of here. Just want to do a quick live, tell y'all, update y'all on this inflation because I was looking forward to it. Hopefully that it was positive news, and it wasn't. So let's see. This guy, what he's talking about.
ETFs allow investors to bet against or short the stock market. In this video, we'll look at the best inverse ETFs to profit from stock market downturns.
You could probably buy some ETFs.
Hey guys, John Williamson here, OptimizedPortfolio.com, investing and personal finance. What are inverse ETFs and why should you care? Inverse ETFs can be a market timer's best friend. They allow bears to short or bet against the market. That is, when stocks drop, the value of these ETFs goes up. Typically, bonds are held for downside protection due to their uncorrelation to stocks. A more direct hedge to maximize gains while the market drops is to use inverse ETFs to short the market.
Oh my God, he talks so slow. All right, we're going to speed him up. I listen to everybody on 1.5, but he's super.
Inverse ETFs use derivatives to produce positive returns from market declines. Inverse ETFs are best used over the short term since the underlying derivatives contracts are settled daily by the fund manager. These funds allow investors to short the market without using a margin account. Bears who use inverse ETFs usually target the S&P 500 as inverse ETFs.
That's what I'm looking to short, the S&P 500, because I'm hearing things that, I mean, it's obviously dropped, and which is why I was cautious about shorting it in the first place. I wish I would have earlier, but obviously, can't cry over spilt milk. But I'm hearing 40, it's going to drop 40, 50%, and why not make money on it going down? I got to put something on that.
ETFs for the index have the greatest liquidity, and the S&P 500 is considered a proxy for the broader stock market. Here are the 3 best inverse ETFs to short the S&P 500. They all come from ProShares, one of the leading providers in inverse and leveraged ETFs. First on the list is SH, the ProShares Short S&P 500.
SH
is the most popular inverse ETF with nearly $3 billion in assets. The fund provides a negative 1x daily return of the S&P 500 index. If the S&P 500 index drops by $1, this ETF will rise by roughly $1. This ETF has an expense ratio of 0.89%. Next up is SD.
Okay. All right. I'm going to see before I go into SH stock price. So I'm going to see where it was at. When did he produce? He produced this video, November 6, 2020, right? So we'll go back and we'll look and we'll see. According to this, it's been losing money, which is interesting since you're supposed to be shorting it, right? So he produced this on November 20th, 2020. It was 2020. Oh, look. So it did work. That was the March 2020 crash when it went up. So it went from $23 to $31, which is a big jump. But the interesting part is when he made this video, which was in November 6, 2020. For y'all to see. November 6. Why is it so difficult? It was somewhere around $19. And since then, the market has fallen. And I don't understand why this is falling as well. So it might not be something that I would put my money in because the market's clearly falling and it's not doing what it's supposed to be doing. So we'll see. Next one. Oh, on this video.
Yes, the ProShares Ultra Short S&P 500. Those desiring a little more volatility may want to use leveraged funds. The ProShares Ultra Short S&P 500 is a leveraged inverse ETF providing negative 2x daily returns of the S&P 500. If the S&P 500 drops by $1, this ETF will rise by roughly $2.
All right, SDS. We're going to look at SDS and then we're going to look at the S&P 500 because I don't. Yes. And obviously this one, same with this one. This one is also down since he produced this video in November. It's down to $48. I don't get it. Like, let me see. Easier way to do this. S&P 500. Oops. Trying to see. Oh, so who's that? November 2020. Why is this being so difficult? Yeah, see, I don't. Oh, okay, hold on. February, March, April, May. Yeah, in November it was at 3,500. All right, okay, so now it's starting to make. So it was at 3,600, and now it's at 3,900. I get what you're saying. So basically, it hasn't really. The S&P hasn't fallen to where it was when he produced this video, because in November. Oh, that's perfect. November 6, 2020. We were. November 6, 2020. It was at 3,500, and we're just getting back to the November. We're still not even there yet. So it makes sense that this isn't giving what it's supposed to give. And throughout all of this time, it was climbing. So let me see. Oh, this is S&P. My bad. My brain is bugging. So it should be, I wish I could put them on top of each other because it should be, this chart right here should be the same as this one. I don't know if I could kind of see it because it just looks like it's straight gone. It's been going down this whole time. Let's see, March 13th, 2020. I'm going to find March 13th, 2020. Okay, that's it right there. 27. It dropped to 2,300 on 2020. And this was at 202. Oh, god damn. That's a big drop. So, I mean, I might put some money into this one. Let's see what else you got to talk about. Cause if it was doing 116 and right now it's at $48, if the S&P dropped 1,600 from $48 and it goes right back up to what it was, which was at $200. That's $150 a share. You know, next thing I'm gonna do is I'm gonna let him talk some more, and then I'm gonna look at some of these options as well. Let's see.
This fund has over $1.1 billion in assets and an expense ratio of 0.90%. There's also a negative 3x ETF. It is SPXU. The ProShares Ultra Pro Short S&P 500 delivers negative 3x daily returns of the S&P 500. If the index drops by $1, the value of this ETF will rise by roughly $3.
Ooh, that's even crazier. SPXU. The way I live my life right now is SPXU. SPXU. I'm old, but I'm young. So I'm thinking high risk, high reward. Let me see. It's at $19 right now. It was at $191 at the time. That's kind of interesting because it doesn't seem like three times. That's $90. The other one was about $1.50. This one went up about $100 when it had that big crash. So,
This ETF has an expense ratio of 0.91%. Traders making a short-term bet on an impending crash may want to use this negative 3x ETF to get the most bang for your buck, since its expense ratio is only slightly higher than that of SH. All of these ETFs should be available at any major broker. My choice is M1 Finance. The broker has 0 trade commissions.
Okay, so that's pretty much all of that. Let me see. I'm gonna log into my TD Ameritrade account, and now I'm about to see, what was it? SPXU. Let's see how much these would cost if I wanted to take out some SPXU. If I wanted to take out some options on this. So an option, and I do long-term options as well. What is this? Do I own something on this? No, I don't. So I would do like the January 2024 option at $19. I do a call option for like $620. Sheesh. 620 trade. It's time for me to go to. I'm sorry. I know this is a little boring, but we learning as we go on. So about $800 for 100 shares of this, or if I did $19, 19 times, I'm stupid. That's $1,900 though. That's not bad. I might get like 3 or 4 shares of that, because I mean, if I got it at $19, right? Say I get it at $19, and I learned my lessons from the whole Nikola situation where I lost like $8,000, is because I shot so high up. Like I was just like, I got greedy. So when Nikola was at like $35, $40, I bought put options for like $5, and right now it's at $7. I ended up losing my money when it was around $7, but it never broke $5, and probably eventually will. But I got too greedy. Now, if I wouldn't have been greedy like I won't be anymore with options, I'm just gonna take options at the price it's at. So I would have made a ton of money. So that's what I'm doing. I'd probably do $19, and that'll be $800. I'll probably try to get like 4 or 5 of those. And then say it goes up to $19, 5. Let's say I got 500 shares. And let's say it go up $150. That's $75,000. That's all I got for y'all. I'm about to probably get a couple of those, because we're going to see what happens. Like, everybody's saying it's going to go down. I got a ton of money in the stock market. I got a ton of money in crypto. I need to kind of hedge against what I got going on. So that's all I got for y'all. Like, comment, share, subscribe, and I holla. That didn't work. I holla.